Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're kicking off with some exciting news from Bloom Finance, a Toronto-based company that's just launched SafeRate, Canada's first reverse mortgage with a lifetime fixed interest rate. Steve, this is quite a game changer for Canadian homeowners aged 55 and older, isn't it?
Absolutely, Sandy. Bloom Finance is really setting a new standard here. With SafeRate, they're offering a stability for life guarantee, which means borrowers won't have to worry about fluctuating interest rates or renewal premiums. This could really help older Canadians manage their retirement finances more effectively, especially given the rising living costs.
That's right, Steve. And what's really interesting is the right to move option. It allows borrowers to keep their mortgage and rate if they decide to downsize without any penalties. This flexibility can be crucial for retirees who might need to adjust their living situations as they age.
It's a thoughtful approach, Sandy. Plus, Bloom is offering prepayment fee waivers within 3 years of the first homeowner's death, or if the last surviving homeowner moves into long-term care. This shows a level of compassion and understanding of the challenges faced by seniors today.
Ben McCabe, the founder and CEO of Bloom Finance, mentioned that for many Canadians aged 55 and over, rising living costs make it hard to balance financial security with a good quality of life. SafeRate is designed to address these issues by unlocking the wealth in their homes, providing predictability, and protecting their families.
Exactly, Sandy. With 3/4 of Canadian retirees owning their homes, there's a growing demand for solutions like SafeRate that let seniors access their home equity without having to sell or downsize. It's about giving them control over their financial futures while allowing them to enjoy their golden years.
Bloom Finance seems to be positioning SafeRate as the most consumer-friendly reverse mortgage option available in Canada, focusing on long-term rate certainty and family-oriented safeguards. It's definitely a significant development in the reverse mortgage market.
It certainly is, Sandy. This could be a pivotal moment for the reverse mortgage industry in Canada, providing a model that others might follow. It's all about empowering older homeowners to stay in their homes and maintain control over their financial futures.
As Canadians settle into 2025, the Bank of Canada is gearing up for its first lending rate announcement of the year on January 29th. The big question on everyone's mind is whether the central bank will continue its rate-cutting trend from 2024 or decide to hold steady. Currently, the lending rate stands at 3.25%.
TD economist James Orlando suggests that a 25 basis point cut is likely, which would bring the rate down to 3.00%. This would be a smaller reduction than the 50 basis point cut seen in December. Orlando points out that the central bank has been adjusting its strategy, with a 50 basis point cut also occurring in October. We are in this sort of neutral range that does not choke nor stoke economic growth, Orlando explains.
This potential rate cut could make borrowing cheaper for Canadians, especially those with variable rate mortgages. More of their payments would go towards the principal rather than interest. However, for those with fixed rate mortgages, the immediate impact might not be as significant since these are often tied to bond yields.
On the flip side, if the Bank of Canada decides to hold the rate at 3.25%, it would signal confidence in the economy's current resilience. Orlando mentions, the current resilience of Canada's economy supports the justification for a rate hold. The recent Statistics Canada report showing a significant job increase in December 2024 backs up this view.
There's also the looming question of external factors, such as potential U.S. tariffs on Canadian exports, which could impact the decision. With President-elect Donald Trump threatening a 25% tariff, the bank might opt for a rate cut as a precautionary measure. There's fear that Trump's going to implement a slew of tariffs or measures that will negatively affect the growth of the Canadian economy, Orlando notes.
The upcoming inflation report from Statistics Canada, due on January 21st, will also play a crucial role in the decision-making process. Historically, inflation was above the 2% target, prompting previous rate hikes. However, Orlando is optimistic, suggesting inflation has stabilized around the desired 2%, which could ease pressure on the central bank's decision.
Looking ahead, TD Economics forecasts a total rate cut of another 100 basis points by the end of 2025, potentially bringing the rate down to 2%. When rates were at 5%, they were exuding a lot of pressure on the country. Now that rates are around 3%, they're not putting as much pressure on the economy, Orlando states. We think that something around 2% is probably where the central bank is going to settle. The Canadian housing market has been quite the roller coaster this year, hasn't it, Steve? Earlier in 2025, we saw a bit of a cool-off, with national home sales dropping by almost 5% in March compared to February. But it seems like things might be starting to heat up again. What do you think?
That's right, Sandy. The Canadian Real Estate Association reported that the MLS Home Price Index fell by 1% during that same period. But as spring came around, we started to see a slight uptick in home sales. May saw a 4% increase month over month, followed by a 3% gain in June. However, we can't ignore the economic uncertainties that still loom large.
Absolutely, Steve. TD economist Rishi Sandhi pointed out that US-Canada trade tensions and the job market are significant factors affecting housing demand and prices. Even as sales improve, they might not reach the heights we saw during the pandemic. The market uncertainty, particularly in British Columbia and Ontario, continues to play a big role.
Exactly. The strength of the market is expected to differ across the country. The prairies seem to be in a tighter market, favoring sellers. Meanwhile, Ontario and British Columbia might remain sluggish due to too much supply and not enough demand. This could lead to more price negotiations and potentially lower prices.
And speaking of prices, condo prices in the Greater Toronto Area have been on the decline. Rishi Sandhi forecasts that by the end of 2025, they could drop between 15 to 20% from their 2023 peak. That's quite a shift, especially for those looking to buy in the GTA.
It is, Sandy. With the Bank of Canada having already cut its lending rate twice this year, there's speculation about another rate cut. This could provide some stimulus, particularly for variable rate mortgages, potentially giving the housing market a modest boost.
Looking into 2026, Sandhi expects stronger growth in home sales and average prices if the economy improves and uncertainty reduces. However, the bounce back might be tempered by affordability issues in key markets like Ontario and British Columbia. But for the GTA condo market, improving affordability could help sales pick up again.
That's a good point. As prices have come down, affordability has improved, which might give the condo market a chance to recover. While we may not see the peak pandemic levels again, the market is expected to find a more balanced spot moving into late 2025 and early 2026.
The Greater Toronto Area housing market has been quite a roller coaster this year, with a brief upswing in bidding prices earlier this fall. However, that trend didn't last long, as sales have dropped by 2.3% from September, according to a report from the real estate firm Wahi. Steve, what are your thoughts on this development?
Well, Sandy, it's interesting to see how the market is cooling off. The average price for a detached home is down by 7.3%, and condos have seen a 4.7% drop. This might be good news for buyers, as lower home prices and interest rates could make purchasing more affordable. However, there's still a lot of uncertainty out there.
That's true, Steve. The cost of living in Ontario has increased by approximately 2.5%, which could be contributing to this market cooling. Yet, it's not all bad news across the board. In Whitby, for instance, the Lind Creek area is still seeing houses being sold for more than the asking price.
Exactly, Sandy. It seems like Whitby is bucking the trend a bit. The Toronto Regional Real Estate Board's Chief Information Officer, Jason Mercer, mentioned that he expects the market to rebound once there's more economic certainty. This includes clarity on trade with the United States and China, which should help boost home sales.
It's all about confidence, isn't it, Steve? Once people feel more secure about the economic outlook, we could see a shift in the market. Until then, areas like Lynn Creek might continue to stand out as exceptions in a cooling market.
Absolutely, Sandy. It's a waiting game at this point. Economic factors will play a crucial role in shaping the future of the housing market. For now, buyers might find some opportunities in this cooler market, but they should also be prepared for potential changes down the road.
Let's dive into the latest report from Zoocasa, which has revealed some interesting trends in the Ontario rental market. It looks like Oshawa has seen the most significant drop in rent prices this year, with a decrease of nearly $260 from January to September. That's quite a substantial change, isn't it, Steve?
Absolutely, Sandy. A drop of 12.8% in rent prices is quite a shift, especially when you consider that unemployment in Oshawa rose slightly from 8.2% to 8.8% over the same period. It's a bit of a paradox, as we usually expect rent prices to increase with higher unemployment rates, but Oshawa seems to be an exception.
It is intriguing, Steve. And while Oshawa saw this decrease, other cities like Toronto and Barrie also experienced rental price drops, albeit not as dramatic. Toronto's rent decreased by about $70, while Barrie's fell by $119. However, these cities still faced rising unemployment rates, which complicates the picture.
That's right, Sandy. The report suggests that the widening gap between wages, rent, and housing supply is a defining economic challenge for Canada. While higher unemployment usually leads to higher vacancy rates and potentially lower rents, the dynamics in Ontario seem to be more complex. It's important to consider other factors, like housing supply and economic policies, that might be influencing these trends.
Definitely, Steve. The report also mentions that despite the challenges, there's room for optimism with stronger job growth and a focus on affordable housing. These steps are crucial for closing the economic gap and ensuring stability and opportunity for future generations.
And it's not just about rent prices, Sandy. Cities like Hamilton and Windsor have seen their rents increase, with Hamilton up by $40 and Windsor by $57. Windsor's unemployment also climbed to 10.4%, partly due to U.S. tariffs impacting the local economy. This highlights the varied economic pressures across Ontario cities.
That's a great point, Steve. It shows that while some cities are seeing relief in terms of rent prices, others are facing increased pressures. It's a reminder of the diverse economic landscapes within Ontario. As we look forward, it'll be interesting to see how these trends develop and how policymakers respond to these challenges. Let's shift gears and talk about the recent developments with the Canadian 10-year bond yield. It's hit a one-month high, climbing past 3.18%. That's quite a notable change, Steve. What do you make of this?
Well, Sandy, this rise in bond yields is largely due to the market's shifting expectations. Initially, there was a lot of talk about imminent rate cuts, but now it seems there's a growing belief that we might see a longer pause in easing. This shift is influenced by the latest labor market data, which showed a drop in the unemployment rate from 7.1% to 6.9% and an increase in national employment by about 66,600 jobs.
That's right, Steve. And with wage growth accelerating to roughly 4%, it suggests that the economy might be stronger than expected. The Bank of Canada has emphasized the need to maintain a contractionary policy stance until inflation is clearly back to target, especially as the trimmed mean core gauge has reached its highest level since February 2024.
Exactly, Sandy. Those higher inflation readings are pushing up expected real rates, which means the Bank of Canada is likely to keep interest rates elevated for the time being. Additionally, Ottawa's wider fiscal deficit could lead to increased sovereign issuance, which would add a larger supply premium on long-dated government bonds.
It seems like external factors are also playing a role here, Steve. U.S. Treasury yields have firmed up following progress on government shutdown talks and mixed economic data. This external pressure can influence Canadian bond yields as well.
Absolutely, Sandy. The interconnectedness of global markets means that developments in the US can have ripple effects here in Canada. As US yields firm up, it can lead to upward pressure on Canadian yields, especially when combined with domestic factors like the labor market and fiscal policy.
So, Steve, what does this mean for the average Canadian, especially those with mortgages or looking to invest in the real estate market?
For those with fixed rate mortgages, the impact might be minimal in the short term, but if bond yields continue to rise, it could lead to higher fixed mortgage rates in the future. For potential homebuyers, this could mean a higher cost of borrowing. It's a reminder for Canadians to keep an eye on these economic indicators and consider them when planning their financial futures.
In the world of mortgages, there's often a bit of confusion about what mortgage brokers actually do and how they differ from traditional banks. A recent article by Jared Linzon shed some light on this topic, revealing both what brokers do and what they don't do. Steve, it's interesting to see how Canadians are increasingly turning to mortgage brokers. According to the 2025 Consumer Survey by Mortgage Professionals Canada, about one-third of Canadians used a broker for their current mortgage, and a significant majority of those who have used a broker plan to do so again. What are your thoughts on this trend?
It makes sense, Sandy. Mortgage brokers offer a level of flexibility and access to a range of products that you might not get from a single bank. Colin Shea from TMG Performance describes brokers as the bridge between lenders and Canadians, helping to smooth out the communication between the two. This role has evolved significantly over time, and it's clear that brokers can now work with clients across all credit levels, offering products from Canada's major banks as well as non-bank lenders.
That's a great point, Steve. There's a common misconception that brokers are only for those who can't get a loan from a traditional bank, but that's not the case anymore. Brokers have access to a wide array of financial products, providing more options for clients. They also tend to have a deeper understanding of the mortgage products they're dealing with, often surpassing the knowledge of generalists at bank branches.
Exactly, Sandy. Another misconception is about the fees. Many people think they have to pay brokers directly, but that's not usually true. For traditional mortgages, the broker's compensation comes from the lender, not the borrower. There are cases, like with private mortgages, where a fee might be charged to the client, but these are generally disclosed upfront and are regulated.
Absolutely, Steve. And it's important to note that brokers are licensed professionals. They undergo specific training and must adhere to regulatory standards, ensuring they're equipped to provide tailored advice that you won't necessarily find online. This personalized service can be invaluable for Canadians navigating the complexities of the mortgage landscape.
That's right, Sandy. While online resources are plentiful, they can't replace the personalized service that a knowledgeable broker offers. As Katie Caravaggio from MPC points out, brokers dig deep into a client's financial history to offer the most suitable mortgage options. It's about understanding individual needs and providing expert guidance.
It's clear that mortgage brokers play a crucial role in helping Canadians make informed decisions about their home financing. As we wrap up this discussion, it's evident that the value brokers bring to the table is significant and continues to grow. Their ability to offer diverse options and personalized service is something that can benefit many Canadians in today's market.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.